Market briefing for retail investors, April 2024. Introduction. Today, we'll break down the most important market development shaping your investment decisions. From macroeconomic trends to sector-specific insights, this briefing will give you a clear view of where opportunities and risks lie. Let's get started. 1. Inflation trends and central bank policy. Inflation remains above target in many economies, driven by persistent supply chain bottlenecks and energy prices. The Federal Reserve and other central banks have signalled a cautious approach, balancing rate hikes with economic growth concerns. Market expectations now price in a slower pace of rate increases through the second half of the year. Actionable takeaway. Prepare for continued volatility in interest rate sensitive sectors like real estate and consumer discretionary. Consider defensive stocks and bonds with shorter durations. 2. US economic growth outlook. GDP growth projections for Q2 have been revised slightly downward due to weaker consumer spending and export challenges. Labour market remains robust, supporting household income despite inflation pressures. Corporate earnings forecasts show mixed signals, with tech and healthcare outperforming cyclical sectors. Actionable takeaway. Focus on companies with strong balance sheets and pricing power that can weather slower growth. 3. Tech sector developments. Artificial intelligence and semiconductor stocks are driving innovation-led rallies, but valuations remain stretched. Regulatory scrutiny on big tech firms is increasing, particularly around data privacy and competition concerns. Supply chain improvements are easing component shortages, benefiting hardware manufacturers. Actionable takeaway. Selective exposure to high-quality tech firms with sustainable earnings growth is advisable. Avoid speculative bets. 4. Energy markets and renewables. Oil prices have stabilized near $80 per barrel amid OPEC plus production discipline and geopolitical uncertainties. Renewable energy investments continue accelerating, supported by government incentives and corporate sustainability goals. Battery technology advancements are reducing costs, boosting electric vehicle adoption. Actionable takeaway. Diversify energy holdings between traditional producers and emerging clean energy companies to balance risk and growth. 5. Emerging markets. Outlook. Emerging market equities are under pressure due to stronger US dollar and tighter global liquidity. China's economic reopening is progressing, but growth remains uneven across regions and sectors. Commodity exporters benefit from steady demand, but geopolitical risks persist. Actionable takeaway. Consider selective exposure to emerging markets with strong domestic consumption and commodity sectors, while hedging currency risk. 6. Consumer trends and retail sector. Consumer confidence is fragile, influenced by inflation and interest rate concerns. E-commerce and digital payment platforms continue gaining market share over traditional retail. Luxury goods and discount retailers are showing resilience amid economic uncertainty. Actionable takeaway. Invest in retail companies adapting to digital transformation and those targeting resilient consumer segments. 7. Fixed income and credit markets. Treasury yields remain volatile as investors digest economic data and central bank signals. Credit spreads have widened slightly, reflecting cautious sentiment, but no broad distress. High-yield bonds offer attractive yields, but carry increased default risk in a slowing economy. Actionable takeaway. Maintain diversified fixed income portfolios, emphasizing quality and duration management. 8. Real estate market dynamics. Residential real estate is cooling in many regions due to higher mortgage rates and affordability challenges. Commercial real estate faces shifting demand patterns, with logistics and data centers outperforming office spaces. REITs provide income opportunities but require careful sector selection. Actionable takeaway: focus on real estate segments, benefiting from structural trends rather than cyclical demand. Conclusion: in summary, the current market environment demands a balanced approach. Inflation and interest rates remain key variables, while sector-specific opportunities exist in technology, energy, and select emerging markets. Risk management through diversification and quality selection will be critical as economic growth moderates. Stay informed and adjust your portfolio to align with these evolving conditions.